All right, hello guys, glad to have you on board again today. Of course, I hope you know that we're going to get an FOMC meeting today, ECB as well. Tomorrow is going to be Google, Apple, and Amazon as well, and a bunch of others. So lots of big names releasing earnings tomorrow. And just to put some spices on top of it, we're going to get an NFP on Friday. So TLDR in here, boys, it's going to be crazily volatile, or at least it could be. So in that sense, I'd rather like to put a little bit of humble reaction to this. And this is what I'm going to try argue on today. So first things first, whatever trades we might have done, normally on Wednesday, we keep on looking at shorter time frames, H1, H4. And in that perspective, the contexts haven't changed that much. Remember, we're still trading the same old flow trading. 2 flows have already occurred, and we might be on the verge to trigger the third one. In order to do it, we need to break out of this previous resistance, and until we did, that means there's nothing but noise. On the other hand, even if we were to fail, which could be a possibility, meaning that we fail to break and we reject that resistance, that certainly doesn't make it any bearish, okay? As long as we still maintain to build a bottom or maintain prices above the 3,700, there is still a possibility to just build another bottom and try breaking afterwards. I know it may sound like, well, what are you saying, Phil? There's no consistency in your things. Oh, this is the only thing there is, okay? Remember that when you're flow trading, the only rule that must be applied is the fucking Doe theory. Every flow trading there is must have higher highs and higher lows. And that means anything now that happened in between 4,100 and 3,700 is fucking noise. And whoever is trying to make sense out of it is just going to drive himself crazy. So just make it easy on you guys, okay? Flow trading is not something you can predict and it can take so many variable forms. Though this one may look crazy to say, well, if we have to do all of this until doing this, well, it doesn't change anything. We still have to do it anyway. Okay, so make it easy on you guys. Lots of things can happen. Anyway, for now, it seems that it's still positive, and I personally still think that there are reasonable chances, technical chances, that we just break out of this. But you cannot ignore the fact that such big catalysts are ahead of us, and that, of course, you have no control over those catalysts. Though, don't listen to the analysts and stuff like that. It will say, well, maybe this or that, and Powell will destroy or whatever. You don't know anything about it. Just try to make it easy on you guys. Technically speaking, it was looking bullish so far. Still does. But that doesn't necessarily mean you can outrageously say you know the future. It just looks okay, and I personally think that this flow is just ready to rocket ship, but we don't know anything about that. And if it rocket ships, does that mean we're going to the moon? Or no, you don't know anything about that either. All you know is that this thing will be needed to be followed as long as it doesn't build a third range boundary. Anything right now, you would say, Phil, we are building a third range boundary now. Yeah, but we don't pay attention to this one. Third range boundaries are the one we care once the flow is validated, which means we need to break above the previous resistance, aka the 4,200. We need to break above that level, and then God knows how long it's going to push. Can be just a couple of days or could be a few weeks. This is not something you can control. You don't control the timings in the market and not the amplitude as well. You're just going to let the market makers work its way until it builds a third range boundary. And this is where you know, okay, I'm taking my profits and I'm moving away. Though until then, just assess that there's nothing you can control. Don't try to seek that control. It's not going to happen. Make it easy on you guys, okay? But until further notice, it just works that way. What have I been doing lately is just exactly what we've mentioned last week, meaning that I am cautiously optimistic, though I'm buying low, selling high. When I say sell high, I partial profit take high. So this is what I've done. I've partial profit took in here, reinvested, partial profit took, reinvested, partial profit took somewhere around there, I guess, or there, I don't remember. And guess what? Yeah, of course I reinvested yesterday. And now, of course, as we headed into this FOMC meeting, I decided to take my profits early just because I don't want to be among those who will play the short-term volatility and stuff like that. So this is the way it is. I have still my trades that I've been taking on this area, okay? Though, to put it plain simple, I've taken all the remaining profits that exceeds the general 2% risks that I would take. So basically, I took away all the profits that I made by arbitraging ups and downs in here. Though this is still a nice gain that ensures me one thing, that if for whatever reason we go right back down there where my stop losses are, I will lose all of those gains, but at least I will still have some gains already booked in. But of course, this is partial profit taking, meaning that I am still largely favorable to more upside and to the for this flow trade to actually finally trigger itself. Until then, well, like I said, assessing the dangerosity of all the catalysts ahead of us. There's so many different forms it can take. I mean, we've got central banks, we've got massive GAFA kinds of earnings release. So, and then we've got the NFP, so fundamental data from the actual economy. These things, these three things combined are just, well, to be honest, worth maybe being humble a bit, even though the technicals definitely looks more favorable to upside than to downside. You have to assess that on those H1 timeframes, well, we could go right down there. And if we do this by just, I don't know, all the planets align negatively for whatever reason, that doesn't change anything to the background scenario. So we could very well do that. And if it happens, I would like to say, well, partial profit taking kind of makes sense. It just secures some of the gains that are here to compensate for the risks you've taken. But the thing is, if you cut it all off the table, like to say, well, man, this is a very, very big trade. I've made so much money. I have no technical reasons to exit, but I will because I fear of the reactions the market could have out of these catalysts. If you do this, well, like I said, might be a wise choice for this time around, and you won't know that until it happened, but it is a stupid choice to make and repeat over time. You must not let yourself influence by catalysts. You should always look at your fucking charts and apply the same old rules independent of external catalysts. But on that specific matter, like I said, if you have been arbitraging the market ups and downs like that, or even if you didn't, I still think having some kind of mixed reaction to this, meaning you certainly don't get out, but I would say a partial profit taking, it's up to you to define, but I would say maximum 50%, though anything above 50% profit taking in here is a mistake to me. Not necessarily on that trade, because if for whatever reason you take it all out today, you take a nice gain from all of these upswings, and it ends up doing this, you would say, oh, I've made that good decision. I'm really good at it. Oh, thankfully, I've taken those profits. Okay, so think of it that way. Out of 100 trades, I don't necessarily know anything about where prices are going to go. Out of 100 trade in this situation, I would just let myself ride. That's really the way it is. Though as I've taken some risks by arbitraging peaks and trough prior to that event, I'm taking all of the gains that I've made by arbitraging this thing, which leaves me with the original positions in here kind of fully open. And I'm really ready to lose that gain if it ever goes down this road. It's really, really hard to say for some people or how to understand, but this is the way professional works. I've been taking some risks, and for now I have no sufficient reasons to change the risks framework, and therefore I don't. But I still take the risks that I've taken on much short-term arbitrage. Okay? That's the thing. And of course, you really need to understand that nothing has changed with my longer-term portfolio. Anything that is all my weekly trades bought in the portfolio, remember, I haven't bought indices back then, I bought some stocks. So the thing is that all of these stocks, I certainly don't do anything about these. Okay? Though that's really, really crucial for you to understand. Don't mix it all up together. I think the short-term arbitrage should be taken away ahead of the volatile events ahead of us. But the thing is that the flow trading you might have taken on the latest bottoms, I don't see any rational reasons to take them off. You can partial profit take on these just to, like I said, secure a nice gain, but anything above 50% profit taking is a mistake on the longer run. Try to put yourself into a professional trader perspective. You will have to make some decisions like that over and over again, and if you make bad decisions once, you will do it consistently, and this is the difference between professional traders and those who will forever have neutral outcome, like mixed stuff. When the market goes up, sure, you're making some profit. When the market goes down, you're losing it all, and that's basically very dangerous, okay? So that's the thing. Until then, I will pay a lot of attention to the 10-year yield as well. not on these time frames, sorry. So on the H1 time frame, the ones we care about in here, the latest resistance to pay attention to are this level and this one. So anything that happens in between would be kind of cautious. As you can see in here, there's no clear trend on this market, so don't pay too much attention to the context. All I would say in here is that what matters, we are in the lower time frames of low risk, so anything in here is volatility. So I would say I won't pay too much attention to the 10-year yield until it does figure out its way to the upper Bollinger Bands or the lower Bollinger Bands. Okay, so breaking this resistance and reaching out the Bollinger Band would be a sign of decrease in the 10-year yields to me. Otherwise, breaking the resistance and going right up there is necessary to see an upswing. So it's not just testing this price or this price. I want the market to fulfill the prophecy by going right up to the Bollinger Bands in both cases. All right, so that's for the 10-year yields, and until then, well, I don't know where it's headed. I still think that the yield curve is pretty tensed right now, and I would like to see a bit less tension on that front, and possibly, to me, by seeing the 10-year yield moving up according to the higher standards of inflation that we should expect ahead of us. I'm definitely not paying any attention to the euro dollar or dollar itself. Way too tricky of an area that we're in, and to be honest, I think whoever trades euro dollar now is just absolutely nuts. So really, that's the way it is. For cryptos, finally, same old story. Okay, remember that the trades in here and the context are different. I see a lot of people saying, well, if Wall Street does that, then cryptos will do that. Well, stupid. Okay, different context, so make it easy on you guys. It's the same reference time frame, weekly bottoms, and in that perspective, we look for H1 flows. We've had one in here, and this is the second one. Okay, so the second flow, when we've said that this is different in Wall Street, we've already played two flows, and we might be triggering the third one. Well, in here, we're still trading the second one, so totally different flow context and must be traded differently. So what does that tell us? That tells me that as long as we do not have a third range boundary, I'm not going to have any concern about Bitcoin, which means, well, if for whatever reason we decide to go up, remember what we said last week, it definitely, to me, start to look like a washing machine pattern, but it's hard to say. But if we go up, well, that will be the confirmation of it. That means we have impulsion, consolidation, flat, narrow, low volatile consolidation, big nice impulsion, and same old story again, flat consolidation, impulsions, and the like. And if we have that, well, we're going to keep washing the bears step by step in this kind of crab pattern. Okay, that's the way it is. And until then, if we break out of it, just like I said, think of it that way. What is going to happen? One flow, two flow, you know, we are going to buy the Bollinger Band. I'm going to buy this for the third flow to come on Bitcoin. So I don't know how the bears can convince themselves, but personally, I will follow these rules. If Bitcoin goes down, I'm going to buy again. That's really the way it is. I'm still bullish in this flow, and I've done exactly the same strategy as I did with the S&P 500. I have locked on some partial profits just because if it goes lower, I'm going to have to buy again. So I basically took some profits while still accounting for the possibility that I don't have a third range boundary in here, though I am still bullish in this market. Same thing goes for Ethereum, which is slightly different in its movement lately, but same old story, impulsion, flat consolidation. We could have a third range boundary in here if we break, which means I would buy Ethereum quicker than I would eventually buy Bitcoin. But the thing is that anyhow and anyway, that's the same old story to me. Volatility alert in here leads me to believe that there is a slight chance that we do exactly like Bitcoin, meaning after a flat impulse, we start to build the same old 45-degree angle kind of washing machine pattern. Okay, with a slight delay, meaning Bitcoin has already made two steps in this step sequence kind of market. Ethereum might still be working the first one. So we'll see all about that. I would say I have a bit more uncertainty when it comes to Bitcoin. It seems anyway that Ethereum, if it ever goes down, is not going to go that low. That's pretty much all about it. Both case scenarios to me are if they headed lower, there's going to be an interesting scenario to build up a position for the third flow that's going to come. Okay, remember, same old story in here. It can work its way into the Bollinger Band, just have wider stop losses. Okay, so account for the volatility, but I don't see any bearish signs for cryptos at the moment, but it is not a moment to buy blindly and so on. Same old story in here. Don't forget that if you had made longer term investments on higher time frames and low risk time frame strategies, Jesus, don't mix them all. Okay, it's really two different stuff. I'm talking about the flow trades in here. Okay, this is like just tiny trades that just bring some additional gains, but where true traders make money are on those low risk strategy timeframes where you expose a portfolio. That is really how it goes. Okay, don't mix things up. Really the message. Okay, really important. But the other message is, boy, you can't ignore that we've rarely got such big catalysts all concentrated in a 3 days time scale. So it's really, really stupid to me to say, well, look at the technicals, bro. It looks bright and shine. Let's be bullish. I think it might worth thinking twice and say, yeah, maybe some partial profit taking would be smart in here, just because of so many catalysts in such a short notice. This is a rare type of event that you rather like to say, well, maybe it's worth stepping back for a second, taking some partial profits, while still not cutting the trade. Okay, the fear of catalyst doesn't necessarily is a new reason to cut a trade that is technically looking okay. All right, that's the message. You have to balance these two things. Do your own sauce, but to be honest, there is no simple answer for everyone. I try to give you kind of boundaries to this. I would say anything above 50% profit taking is irrational to me. That's too much. But anything like zero, like I'm fully confident and I'm keeping all my trades open, seems pretty damn irrational to me as well. So try to find your shaded gray areas in between. And that being said, I see you guys on the other side. So see you on Monday when all of those catalysts will be passed. Bye, guys.